Okay, so that's a lump sum purchase. Let's go then to short exercise 2 and practice. And exercise 18 is what we'll do in our lab time today. Because there's one more that we can do if you wanted to do another one. So it says on page 588, short exercise 2, rural tech support paid $130,000 for a group purchase of land, building, and equipment. At the time, the land was worth $70,000, the building $56,000, the equipment $14,000. So we have 3 assets here in the shrink wrap package, right? In the lump sum purchase. Journalize the lump sum purchase of the 3 assets for a total cost of $130,000. The amount for which the business signed a note payable. So there's no cash, it's all credit note payable. The question is, how much do you debit? How much do you capitalize to land? How much do you capitalize to building? How much do you capitalize equipment? You cannot debit land 70, building 56, and equipment 14 because it won't balance. That's more than 130. And you're only crediting 130. So your debits would not equal your credits. So that's why we're doing this, is bless you, to figure out how much of the 130 goes to each asset. Because if you just put down the fair market values, it won't balance. Okay? So in this case, land, building, equipment. And it tells us our fair market values must be given. Actually, the first thing it tells you, so I'll take one piece of information at a time and fill in my blanks. It says they paid $130,000. So I know this. I know it's $130,000. And the land had a fair value of $70,000, the building $56,000, and the equipment $14,000, for a total of $140,000. So again, if we debit each of those things, we'd have debits of $140,000. We'd have a credit to note payable of $130,000. It wouldn't balance. But 70 divided by 140, I can do that. 50%, right? I'm doing it in percentages this time instead of fractions. You can do it either way. Half, 70 1/40ths, whatever you like. 56 divided by 140 is 40%, and 14 divided by 140 is 10%. And when I add them up, lo and behold, I did my math right, bless you, and you've got 100%. So far, so good? Now, we're going to take 50%. Are you ready? 50% times 130 is 65,000. 40% times 130 is 52,000, and 10% times 130 is 13,000. And our journal entry is debit land 65,000, debit building 52,000, debit equipment 13,000, credit note payable 130,000. What page am I on? 588, short exercise 2, and your answer is right there. So far, so good? Gina.
How do you get the percentages again?
70 divided by 140, 56 divided by 140, and 14 divided by 140. So this is your denominator for all 3. And that number, the fair market value, is the... So what they're saying is, here's the pie. The pie is worth $140,000, but we only paid $130 for it. And this number could be bigger than that number, it could be equal to that number, or it could be less than that number. Okay? And it doesn't matter. For some reason, we paid $130,000 for it. They gave us a bargain. In this case, it's a bargain. So we're not recording it at its fair market value, we're recording it at its cost. But we're assigning the cost based upon its fair market value. The basis of the pie is fair market value. So if 70,000 of our package of 140, half is land, then half of this should be the cost of the land. Is that clear? Making sense? You can do this. All right. The next part of the chapter talks about capital expenditures, which would be debit to an asset, and revenue expenditures, which is debit to an expense. I don't know why they don't tell you that, but that's what it means. A revenue expenditure would be an expense. Expenditure against a revenue, expenses, okay? So, in that section, they talk about things like, so you have a delivery truck, and you put new tires on the delivery truck. Well, that's just an expense. That's a routine thing that you're gonna have to do, right? Or you change the oil in the delivery truck, debit, expense, credit, cash. But if you put a new engine in the delivery truck, that's a major improvement. That's a major, okay, which will extend the life of the asset. So anything that is a betterment, or extends the life, or makes it more efficient, or more expedient, makes it better, rather than just your wear and tear normal things. You know, now, I know, if you don't change the oil in that truck, it won't last as long. But it's still something you know you should do. The normal wear and tear of the truck. Those are debit, expense, credit, cash. The engine is debit to engine, credit, cash, capitalize it, and depreciate it. Okay? And so, let's do exercise 19. Page 591, exercise 19. Consider the following expenditures. Would you capitalize them, debit an asset, or would you expense them, a revenue expenditure? So a purchase price obviously would be capitalized, right? Debit an asset. Ordinary recurring repairs to keep the machinery in good working order, expense. Lubrication before the machinery is placed in service, capitalize. All costs necessary to get it ready for its intended use. So that would be capitalized. Periodic lubrication after the machinery is placed in service, expense. See the difference? Major overhaul to extend the useful life, capitalize. Debit the asset and depreciate it over 3 years. Sales tax paid on the purchase price, capitalize. All costs necessary to get it ready for its intended use. Transportation and insurance in transit from the seller to the buyer, capitalize. Installation, capitalize. Training of personnel for the initial operation of the machinery, capitalize. All costs necessary until it starts working, and then the only thing you capitalize after that is betterments and improvements, okay? And everything else is an expense. Got it? Cool. Okay. Let's chunk that again. I'd rather have it be in smaller pieces.
Yep.